Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
The ATRAM Alpha Opportunity Fund Incorporated has one mission: to look for the winners of tomorrow. The fund actively finds the fastest growing Philippine companies with high quality management and sound business strategies. This growth has often translated to higher stock prices. The fund has a proven track record of selecting companies outside the Philippine Stock Exchange Index that were eventually included in major indices, while most funds in the market stay within the Philippines' top 30 companies. This has led the fund to consistently outperform the market in the long term. Furthermore, the fund invests in long-term drivers of growth that could provide significant gains for investors, such as technological advancement, tourism, infrastructure, and sustainability. Invest in the potential of the best growth stories the Philippines has to offer. Invest in the ATRAM Alpha Opportunity Fund Incorporated. For more information, visit www.atram.com.ph.
Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With ATRAM Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At ATRAM, we're making lives better through investing.
Good day, everyone. I'm your host for this afternoon, Stanley Magna from the Digital Channels team. And I'd like to welcome you all to our webinar, Harnessing the Power of Philippine Growth, featuring the ATRAM Alpha Opportunity Fund Incorporated. Now, the world is slowly bouncing back post-pandemic, and a common theme in the markets is uncertainty. There's tightening monetary policies in anticipation of recession. The Philippine economy, on the other hand, is on the path to recovery and performing exceedingly well, growing faster than it did in 1976, with a GDP growth rate of 7.6 in 2022. But there are a few bumps in the road for this year. Our goal for this webinar is to help you find opportunities amidst uncertainty. To shed more light on this matter, we will be joined today by one of our own from the equities team, who has 6 years of industry experience under his belt. Our speaker will be discussing the Philippines' impressive rank as the second fastest emerging economy in the world, its untapped potential in the market, and the relevant key growth factors, economic indicators, challenges, and volatility associated with investing in the market, and how one of our own funds, the ATRAM Alpha Opportunity Fund Incorporated, performs well, despite the volatility, illiquidity, and heightened risk associated with the mid to small cap space. All right, what we hope with the end of this webinar is that you, our dear audience, will have gained a deeper understanding of the Philippine market and how this may influence you in your investing decisions and financial considerations. But before we begin, I know everyone's excited. We're letting you know that this webinar will be recorded and posted on our social media platforms, so you can refer to it whenever you need to. And whether you're a beginner in the world of finance and investments or a seasoned investor who wants to stay up to date, I want to remind you that we've got you covered via our YouTube channel, ATRAM Studio. We have a collection of videos that features everything that you need to know about finance, investments, and our past webinars, and even ATRAM itself. Don't forget to subscribe to our official YouTube channel and hit the notification bell to receive alerts on your devices whenever we upload new videos. You can also find these on our website at www.atram.com.ph for more comprehensive information on the market, finance, investments, and all the funds we provide. All of these can be found on our social media pages. So don't forget to follow us by scanning the QR codes flashed on your screen. And we want to keep this webinar as interactive as possible, guys. So please, if you have any questions, feel free to message. If you have some clarifications during or after the talk, don't be shy and send them over through the Q&A tab found below your screens. All right, now for the meat of the talk, I have the privilege today to introduce our speaker for this afternoon. He graduated from UP Diliman in 2013 with a bachelor's degree in mathematics. And he previously worked as an analyst at Willis Towers Watson, Northern Trust, and First Metro Investments Corporation. Currently, he's the head of equity research at the Equities Department of ATRAM with a strong background covering sectors such as power, utilities, infrastructure, and cement, and his current focus lies in analyzing properties, banks, and conglomerates. He's also a CFA Level 3 candidate, showcasing his commitment to professional growth and expertise in the financial field. Let's all welcome Dionill Jamill.
Hi, hello, good afternoon, everyone. Stan, thank you so much for that very generous introduction. Yeah, you can call me L. And again, as Stan mentioned, thank you so much for tuning in. We know that we're taking a little bit of your time from your day just to tune in, so we really appreciate that. And hopefully by the end of this webinar, not only will you be more well-informed about your investments, but you'd also be enticed to invest in the ATRAM Alpha Opportunity Fund, which we'll get to later. So yeah, let's just kick things off. As Stan mentioned, I'd like to give you a short context of what we're about to discuss, to give you a background of what's happened so far in Philippine markets, what's been the dominant narrative. If you guys, for the more experienced ones, you know that the market has been a little bit sideways, to be generous, over throughout the years so far, and that will encapsulate basically why we're pushing for the ATRAM Alpha Opportunity Fund, and also the strategies that also applies not just for this fund but all the other funds that ATRAM is offering. I know the next few slides will look intimidating, so I'll walk you through it and simplify it as much as I can. So first, CDS, credit default swaps. Now, to contextualize the slide also, what's been the dominant narrative so far in the market, right? And it's been really macro-driven, not just domestically, but also internationally, globally, especially in the US. The peso has depreciated, not just in 2022, but also in the past few months. And that's because the Fed, the central bank of the US, has been aggressively hiking. You may notice it now in if you have any outstanding loans or any interest rates, or if you have any idea about the interest rate that you're paying for your mortgages, for your auto, or any of your loans, it's quite high. It's much higher than in 2021, and we saw the rapid increase in 2022. And that's still the narrative in 2023, although we're not talking anymore about the rate of increase, but we're just trying to plot when the rate of increase will flatten out, and then when it will start going down and cutting, right? So in light of that, a lot of, especially equities, which is considered a riskier asset class, right? A lot of money has been flowing into the US because a higher interest rate means also a stronger dollar. And if the dollar is strong, that comes at the cost of the peso weakness, right? And what's been driving interest rates higher? Inflation, both in the US and also locally. But we've seen already that our own inflation is starting to slow down, right? But now we're just looking at the direction of the inflation, both domestically and in the US, and how the central banks will respond to those inflation numbers, right? Because what we want is for the inflation numbers to start showing deceleration or even deflation, so that the central banks can also start cutting rates, and hence equities or stocks can be relatively more attractive now. And also it doesn't put a lot of pressure in our own currency, the Philippine peso, because the more the US central bank hikes, the more it puts pressure on the peso, because our own central bank will have to match that hike just to maintain the foreign exchange, right? Here, one of the dominant stories of the Philippines is first the interest rates, and then the level of borrowing that our government is doing. yeah, you may have seen it in the news that our borrowing over the pandemic has increased. So it's something that all our economists are keeping an eye on, because that also affects how weak or how strong the peso can be until the end of the year and even until next year, right? The CDS, the credit default swap, is just a proxy of how credit-worthy the foreigners think the Philippines still is. So it's been steady despite recent weakness in the GDP print. Our latest GDP print came in lower than expectations, right? So the recent uptick is coming from the broad Asia ex Japan weakness. Now, we talked about the credit side of the Philippines and how it affects our own currency. Now we look at how the relative attractiveness of stocks, right? Because stocks are considered risky assets, then on the other end of the spectrum, there's a risk-free asset, and that's usually the government yield. So whatever yield any government issued bond is, and it's usually the proxy is a 10-year government bond, right? So you take the difference between what the 10-year government can yield and what the earnings yield of the market can be, of what stocks can offer, right? So you take that difference because that's basically what you're asking for in exchange for taking on more risk. Basically, the wider it is, the more attractive the market is. The narrower it is, the less attractive it is. So that is what the bars are here for, right? So we've seen in 2019, 2020, it shot up to about 4%, and then in 2021 and 2022, it was even a little bit negative and it was thinner. Now we're back to 2%. Historically, we're about 1% to 1.5% spread. That's basically the earnings yield minus the 10-year GSL, government security yield. So we are now in the more relatively attractive valuation spread-wise. Next slide, please. So we talked about the currency before, foreign exchange, right? And as the dollar strengthens, the more foreign funds continue to withdraw from the Philippines, because now not only are they facing uncertainty in the stocks that they're invested in, they're also facing uncertainty in the currency. That's already the hurdle that they're trying to overcome from the currency alone, right? So because of that, foreign funds have been leaving. And this is not something that we've only seen in the past year or two. Foreign funds have been leaving for a while now, and it is affecting the liquidity of the market. The liquidity of the market is the lowest we've seen since the Philippines turned investment grade. So deteriorating liquidity, weak Asia ex Japan performance, and now foreigners are very selective in their buying. So this is weighing down on Philippine equities, right, and the local stock market. Now the foreigners, when they look at the Philippines, it's always relative to either our regional peers or other emerging market peers. And if you look at the indices, regional indices or other global indices that would just stack the regional peers together, the Philippines is very light. And our weight in those indices have continued to decline. So now we're just at 0.62%. Very, very small. So you can only imagine, if you are a foreign fund manager, if you're allocating into the Philippines, you're only allocating 60.62% of your portfolio, right? And compared to about 10% of our regional peers, you're not really investing much anymore. So that's the liquidity, or the liquidity of the market is this graph on the left. On the lower right, that's the performance of the local market, the PSEI, that's the PComp index, relative to regional peers. So MXASJ is the MSCI ex Japan. So that's basically the index containing all our regional peers minus Japan in the region. It's only down 1.35%. The market is down so far by 5%, right? The JCI is Indonesia. It's up 2%. So from that alone, you already see the stark difference in performance. So foreigners are being selective, and the lightweights are, for the lack of a better word, being disregarded, right? So especially for something that's only 0.62% of their overall portfolio. Now, we're not the worst, right? So SET is Thailand, FBMKLCI is basically Malaysia, and HSI is Hang Seng. That's Hong Kong. They're worse than us, but they're also heavier than us. So can you imagine, like, once foreigners find the region attractive again, money will flow from the heaviest to the lightest. So the Philippines is actually a country that's one of the last to receive those flows. Okay, and then here on the top right graph, if foreigners do buy into the Philippines, what are they buying? And this chart shows that so far from January to August, they've been buying our banks, which makes sense. In a high interest rate environment, banks thrive. So they're able to charge higher interest rates. So their core revenues also increase, right? And that may come at the cost of loan growth, because if interest rates are high, consumers and corporates are not really enticed to borrow, right? They'll wait for interest rates to go down. But just the sheer increase in interest rates is offsetting the slowdown in loan growth. So it's very attractive, and this is not something that's unique to the Philippines. Other regional banks are also being bought. Now, the sector right next to it, property, is actually on the other side of the spectrum, right? So you can imagine your mortgage rates, right, going from 6% to 9% or 10%. So you've almost doubled the mortgage that you're paying. So this is a high interest rate environment is actually bad for property, right? And you can see here that foreign funds have been withdrawing most of the time. Now, why do we see green months, right? As you may recall earlier, 2022 was the fastest increase in interest rates so far in the past 2 years. And the market's already priced that in. Now the market is trying to price in when it will start going down, right? Because if you wait for interest rates to go down and that's when you start buying property, you're already too late. So at the start of the year, there were certain expectations that interest rates will start going down by the second quarter, and it didn't. So that's why in January, property was getting bought. But then inflation was persistently high, so it starts getting sold again. So you keep pushing back the interest rate cut expectations. That's why you get Feb to April, right? They started withdrawing again, and then you start building up expectations again, and that's going to be the theme mostly for this year. So when can we expect central banks and hence interest rates start to top off and even bake in expectations of a cut? So far, the expectations are for the first quarter of next year, 2024. If you have expectations of a cut or at least a tapering off in the first quarter of 2024, you don't wait until then to start buying property. You want to get ahead of everyone else, basically, right? So property, you can also see REITs, which are basically the derivative of property, right? REITs are basically the leasing component of property developers. So for now, it's mostly office, and you have some retail baked into that. And it also gets affected by the same factors of their sponsors. And then consumer, this is a sector that benefited a lot from the reopening of the economy, but then you started getting high input costs as commodity prices increased last year. Then they adjusted their pricing to preserve their margins, but now inflation is starting to eat into the top line, into the demand of the top line, right? So that's why it's also not the hottest sector right now. Conglomerates are usually just driven by their property and banking arms, depending on the mix. So some conglomerates are getting bought depending on which subsidiary is driving most of its income, right? So it's a mixed bag. Utilities and telcos, sort of steady over the past few years. So now, usually when there's not a lot of foreign flows coming in, you just have money going in and out, rotating, right? So if you benefited from a volatile environment before, for example, like utilities and telcos that tend to be relatively steadier, right? People would tend to move away from that whenever they want to move money, whenever they want to move to another sector. So that's mostly what happened, especially with telcos that were one of the biggest beneficiaries over the pandemic, right? With their broadband and with their fintech arms. Gaming is actually mostly driven by just one name, Doomberry, right? And it has performed very well because as the country reopened, more and more traffic went into the casinos, and hence people started playing again on site. And the transportation is really not a lot of representative here, but it's really still a beneficiary of the reopening of the economy now. But a lot of that reopening tailwind is already done. We're now just looking at incremental increases moving forward, especially in the international side. Okay, next slide, please. Okay, so now we get into the meat of the webinar title, emphasized on growth, harnessing the growth potential of the Philippines, right? So when we talk of growth, on the macro perspective, we're looking at GDP, and on the equities perspective, we're looking at corporate earnings, right? So how has corporate earnings done so far? Just to put this entire slide into context, we actually expect corporate earnings in the PSE members to grow by 17% this year. That's 17. In the first quarter, corporate earnings increased by 27%. In the second quarter, earnings increased by 25%. So far, they're actually trending ahead. Now, are we inclined to change our forecast just because we saw 27 and 25% increase in the first quarter and second quarter respectively? No, because the base effects will come into play in the third quarter and fourth quarter, right? Before we dive into which the sectors that we highlight, there are already some, for example, bank earnings that already grew really quickly in the third and fourth quarter of 2022. So that will have some base effect there. Also, some property names that will also experience some base effect, and those are the larger components of the index. So first off, how did the actual corporate earnings compare to ATRAM estimates? 50%, half of the PSA were in line with our expectations. 25% beat our expectations, and 25% missed. So that's about the same as the street. When we say street, the other analysts in the industry, versus the street, 46% were in line, 20% beat, and 25% missed. So it's if between us and the street, it's actually the street that would be more inclined to change their estimates. Our forecasts so far were more or less a bit better versus the street. Now, the property sector. We mentioned that this sector is one of the most adversely affected sectors during in a high interest rate environment, and that's mostly because of the mortgages and also and hence it affects the demand both in residential and in office. In retail, not so much, though consumer spending still affects the way mall operators can collect revenues. But we highlight here the residential subsector of the property sector. Ayala Land's unsold inventory levels declined from 24 months to 22 months. So this is an incremental improvement, right? So we want to see demand recover. Maybe just a bit back or a little bit closer to pre-COVID demand. So residential demand is picking up, particularly in higher end segments. The office segment continues to struggle with high industry vacancy rates. So as you may notice now, there's still a lot of companies that have some sort of hybrid arrangement. So not all of their employees are back in the office. So vacancy rates are still up. They're still at 20%. They're still pretty high. When we were coming from single digits during pre-COVID. Right, so now we're still seeing whether or not the work from home arrangement can be sticky. And so far, it's been pretty sticky, right? And SM Prime high cancellation rates weighed down on residential revenue. So over the pandemic, there were some relief that were given to mortgage borrowers, right? And that has already expired. So now it's we saw over the past 12 to 18 months how many actually are still able to pay their mortgages and how many had to cancel their purchases. And hence, the way we're looking at the inventory levels of not just Ali, but the property sector as a whole. Second is our banks. So BPI and BDO sustained 15% ROE, and that's mainly driven by the high interest rates. Net interest margin is how is a key metric in banks because that is basically how much they're lending versus how much they're paying their depositors, right? That's the core banking revenues. And if you have high interest rate environment, banks usually benefit. So their ROEs are mostly driven by the net interest margin expansion. When you look at the loan growth, it's really the consumer segment that's leading the loan growth. Corporate loan growth is still at mid-single digits because corporates right now are still delaying their major capex plans because of where interest rates are. So they're only borrowing just to sustain their yearly operations. But credit spread continues to be tight, signaling credit quality remains high, but borrowers are holding back. So in a high interest rate environment, it's not all good for banks. You have to take a look at their NPL ratios also, their non-performing loans, because there might be some borrowers that are not able to pay back anymore either their interest payments or their maturing loans because of the high interest rate environment. And then consumer, as I mentioned earlier, the high inflation environment resulted in postponement of high value purchases and down trading. But consumer also came from high base effect last year, which weighed down on the year-on-year growth figure for this segment. Okay, next slide, please. Okay, so if you just look at this graph alone, it looks very, very bullish, especially where the market is now. The market is currently trading between 6,200 to 6,300. Now, what are we actually showing here? The TLDR of this slide is really the market continues to offer value, especially at 11.6 times PE, price to earnings multiple. And that's mainly the valuation metric that we look at whenever we assess the valuation of the market. And at 11.6 times, this is already also at pandemic levels. So we think that the market's fair value, given the earnings growth potential, is at 15.8 times. Hence, our fair value assessment of the market of 8,100, right? And we want to emphasize fair value because it's not necessarily a straight line to 8,100. And at 15.8 times PE multiple, to put that also into context, the 10-year historical multiple is closer to 18 times. And 15.8 times is one standard deviation below. So it's even at a discount to the 10-year average. So we're not even saying that we're not even expecting that the market should trade at historical multiples. If you put the market at historical multiples, given the earnings growth potential, then the market's fair value is 9,300, right? That's a bull scenario for us. And what does that entail? It entails foreign flows start to come back, right? They start to come back. They start to see the relative attractiveness of the market and the earnings growth potential. 8,100, as I mentioned earlier, is from a 17% corporate earnings growth and a 15.8 times PE multiple. Now 5,600 is our bear case, which is a 12.8 times, which is actually at -2 standard deviations. of the 10-year historical multiple, and even cutting the earnings growth of the market to just flat year on year. So this is it's like corporate earnings did not grow at all from 2022. That's 5,600. So what does that tell you now? That the market's risk reward profile is actually really attractive. So that is why the diverging corporate fundamentals and market price signals opportunity for those that are looking to take advantage of the market's cheapness. Next slide, please. Okay, so we've talked about our outlook for the broad market. Now, how are we approaching it, right? And we want to emphasize especially the Alpha Opportunity Fund. So the Alpha Opportunity, as some of you may already be familiar, is one of ATRAM's funds whose strategy is very unique. It's only investing in small to mid-sized companies. So what does that look like? 150 billion in market capitalization at most. Why do we do this? Because the fund seeks to deliver long-term superior returns by investing small to mid-cap equity securities, focusing on companies with strong growth potential. So imagine something like an SM or an Ayala Corp, right? Or even a Meralco. These are large blue chip companies whose earnings year in year out is growing already at you can call some of these companies already mature, right? Unless they have like an extremely new business that will drive the earnings growth of the entire group. But other than that, they're already growing at a steady pace. By going to small and mid-cap companies, we're still catching these companies at the middle of their growth phase. So hence the superior growth potential. How do we do this? By rooting our investment selection in fundamental research. It's very important because these companies, because they're small, not a lot of people are looking at them yet, right? And fundamentally, some of these companies, especially their management, are still transitioning from a family-owned business to a more formal and corporate structure. So it's very important that we remain fundamentally rooted, right? Because these companies can still be very volatile, and we have to have strong conviction in these companies during extreme volatility, not just of their corporate earnings, but also of their stock price movements, right? So we have an extensive coverage on companies outside of the top 30 largest companies, which is the PSA. And what do we get from investing in these companies? Growth. We are investing in the emerging growth teams in the market. So this fund caters to investors who have a very aggressive style. They can take a lot of risk in their portfolio. Next slide, please. Yeah, so I've touched on this slightly. This is how we subdivide the entire in our own stock universe. We consider those less than 50 billion in market capitalization to be small, between 150 billion to be mid cap, and large to be 150. So the Alpha Opportunity Fund deals exclusively with small and mid, so at most 150 billion. And why do we look at this? Not only do we want to see growth or identify fast-growing companies, eventually these companies become blue chips, right? We want them to be included in the PSEI, and that's when foreign funds start to look at them. That's when a larger investing population can look at them, right? So we want to get in before that and identify those companies that eventually get into the main PSE index. And how have we fared so far doing this strategy? Over the last 5 years, the fund has beaten the PSA, the PSE Mid Cap Index, the MSCI Small Cap Index, and all other Philippine equity funds. So it is working. And I've mentioned this before. This is for the riskier investor profile. And then the benchmark is actually the the PSE Mid Cap Index. This is an index that the PSE just launched last year, March of last year, if I'm not mistaken. And tracking error is about 4 to 8%. Tracking error is how much we can deviate from the PSE Mid Cap Index. Next slide, please. So, as I mentioned before, one of its key strategies is identifying future PSCI members. And we've been able to identify these 5 companies before they were added into the PSE index. And they've taken different time horizons to get there, like Wilcon, in different ways, not just time horizons, but also ways. Like, for example, DMCI has been in and out of the index. Union Bank has been in existence for a while, before doing some major corporate actions like the city acquisition, right? AC Energy used to exist as a very different entity and transformed itself into a renewable energy play, right? And then Converge is one of the more recent ones, IPO'd in 2021, right in the middle of the pandemic. One of the most in-demand products was fixed broadband, and then Wilcon is also a pandemic beneficiary because so many of us were fixing our homes just to fix the workstations in our homes as work from home arrangements became more prevalent, right? So we were able to identify these 5 companies amongst others before they became PSE members. Next slide, please. Okay, so what's our strategy and sector exposure so far? Just to give you a brief look into how the fund is positioned so far. So a lot of our a huge portion of the fund is currently positioned in gaming, and that's mostly in Bloomberry and Plus, right? And then second would be banking. As I said earlier, that in a high interest rate environment, banks tend to do well, right? And then next would be power/utilities. How are we identifying the companies that we want to invest in right now? First, we are identifying the pandemic winners, and not just the reopening beneficiaries, but actually those that have transformed themselves during the pandemic and have made their operations stronger, like Shakey's, just pizza. Also those that have gained more market share and strengthened their positions within their respective sectors. So one example would be Bloomberry, as I mentioned earlier. Bloomberry's net income and EBITDA is already close to pre-pandemic levels without even banking on international tourist arrivals yet. They're only doing this with domestic traffic, which is really, really good. And the Union Bank over the pandemic also acquired the Citibank retail business, right? So they've now moved into 4th in terms of credit cards. Second, shifting consumer preferences and behaviors. So online gaming became more prevalent over the pandemic, and that's when we identified Plus. And then also digital banking. So we've seen a lot of digital banks launch over the past few years. In fact, the BSP issued 6 licenses, and one of those was Union Digital. We've also seen in the larger corporates would be something like GCash or Maya, right? So in the digital banking, we're limited to Union Bank, and then also event-driven arbitrage. So some of you might be familiar that MPI, there's a tender offer going on for MPI shares, and there's a possibility that it can get delisted. If it gets delisted and removed from the PSEI, someone has to replace it, and the best candidate for replacement is Bloomberry. So we also have some event-driven positioning here in this portfolio. And then lastly, just to tie it back to what I was discussing at the start of the presentation, remember when we kept trying to plot when interest rates will taper off and start declining? This is when the value and value cyclicals would start to rise. So that would mostly be property, and as I mentioned earlier, conglomerates are usually were usually driven by their property and banking arms, right? So hence we then buy the conglomerates also that own those property and banking companies, amongst others, and also some exposure and power and commodities that are currently trading at really cheap valuations. Next slide, please. Okay, on a longer term perspective, how has this strategy performed? And just to guide you, Alpha Opportunity is the black line here, MSCI, MXPHSC, the blue one, was the first benchmark of the index before we shifted to the PSE Mid Cap Index this year, and that's the blue one here. So as you can see, it's a large outperformance of about 40+% over its own benchmark. How did it fare versus the PICOM or even the standard MSCI Philippine index? It still outperformed. So we're here at 118.68. So it gained by about 19% over the past 10 years, despite a very volatile environment. So this is what I said not earlier, that we did not just outperform other PH equity funds or major indices over the past 5 years. This strategy has also worked in a longer term perspective. Yeah, so that was actually the last slide of my presentation. Thank you so much for listening, and if you have any questions, just type it up.
Right, Elle, thank you so much for that insightful talk. Thanks for taking us behind the scenes on the strategies you and the team use to spot opportunities and to find that alpha, I guess, for the small to mid cap companies. I guess this is really the value proposition you guys bring for the ATRAM Alpha Opportunity Fund. The ability to not just stay resilient, have good performance and spot the winners, despite, like you mentioned, the choppy sideways market, right?
Yeah.
More importantly, I guess, to identify also the factors for these and have a managed approach for our investors in the audience to make sure they have winners in their portfolio. I want to remind the audience also, for any questions on strategy, opportunity, anything under the sun, our speaker, Elle, please feel free to leave messages in our chat. And I'm sure, actually, we have a few questions already lined up for Elle. But before anything else, we're pleased to announce that ATRAM has clinched several awards this 2023, a testament to the skill of our team members like yourself, Elle. We want to run through them, and ATRAM was hailed as the best investment solution provider by both the International Business Outlook. The company received the most innovative fund management company of the year, highly commended from the AAA Sustainable Investing Awards 2023 for institutional investor, ETF, and asset servicing providers. And just recently, ATRAM won awards for the best asset manager from Citywire in 2022 and 2023, and the best fund management company from the annual Global Economics Awards. So these recognitions really serve as a testament to our unwavering commitment to managing assets and funds, and our assistance to our clients in achieving your financial goals. As a result of our team's steadfast pursuit of excellence and fund management, we want to continue to push the limits to what's feasible in the industry. And we appreciate your continuing support for our clients and partners. Now for one of the most exciting parts of the webinar, I'm sure you guys have a lot of questions. So we'll be moving on to this Q&A portion of the event. We have a lot of questions already lined up from the audience, so feel free to add more in the chat section, and we'll try to address all of them today, guys. Now, for the first one, Elle, could you kindly clarify how the fund's investment approach differs from just investing in the index directly? I know you mentioned ultimate cap, but are there any opportunities that the fund provides that the index might not cover?
Okay, yeah, sure. Okay, so the main difference is that, as I mentioned earlier, we exclusively deal with small to mid cap companies, so at most 150 billion in market capitalization, right? And that's very that's unique to our fund. Not a lot of funds invest exclusively in those companies. They may have a couple of names invested or mixed into their portfolios, but it's still mostly driven by the large blue chip companies. And why do we do this? So for example, I mentioned earlier, we expect the broad PSEI market to grow by 17% in terms of earnings this year. For the companies that are invested that we are invested in the Alpha Opportunity Fund, we expect their earnings to grow by 32%. So from that alone, as I mentioned earlier, we emphasize growth in this in this portfolio. Now, what unique opportunities does the fund provide that the index might not cover? It was the second part of the strategy, right? if once we identify these companies will keep growing and growing until they're large enough to be included in the index. If you're already invested in the main PSEI index, that's as much as there's only you can either only grow bigger and bigger and move higher in terms of weight in the index, or you can actually, if you fall out of favor with investors, you can actually get deleted, so you fall out of the scope of both local and foreign fund managers. So that's the downside there. What we seek with Alpha Opportunity is are the additions, right? So you suddenly get more eyes, more coverage into these companies as they grow bigger and bigger.
All right. Thanks so much for that, El. Thanks for clarifying the main differences. A lot of clients and some of our audience members might be confused versus just the usual index fund. So thanks so much for clarifying that. Let's move on to the second question for our audience. You mentioned earlier in one slide there's a tracking error range of 4 to 8%. One audience member is asking, can you kindly explain how this metric affects the fund's performance? And how does the fund manage to stay within this range consistently?
Okay, sure. So tracking error is basically how much the fund the individual components of the fund of the performance of the individual components of the fund can deviate from the given benchmark, which is the PSE mid cap index, right? So for example, if the benchmark performed by about 10%, you're usually, if you're tracking errors between 4 to 8, you can be like 14 to 18% up or down of that of the benchmark. That's the volatility that we're looking at, and 4 to 8% is actually quite high if you put into context that most index trackers are just about 1%, right? So they really just stick to the benchmark that they're looking at. For this one, hence the riskier investor profile that this fund also caters to, because the volatility can be high, so the returns can be really high, but that's also true to the downside. Like the underperformance can also be low. So it's a volatile fund.
Okay. All right. Thanks
Sure.
for that.
And sorry, to answer the second portion of that of that question, how do we keep it within 4 to 8%? It's something that we always monitor. We don't want the funds what you call this volatility to get out of control, right? Because we also have a risk management. We also have risk management metrics that we keep an eye on. So one of the ways we do that is that, for example, for very small and illiquid companies, even though we like it so much, we keep their size and their position in the portfolio small, just to manage that volatility.
Okay, yeah, to manage the error and also to stay consistent within the range. I think that's really the value that your team also presents when it comes to these actively managed funds.
Yes.
So thanks so much for that.
Sure.
The third question coming in from the audience, could you kindly provide an example of a tactical opportunity that the ATRAM Alpha Opportunity Fund has leveraged in the past?
Yeah.
Curious about how these opportunities contributed to the fund's success.
Yeah, sure. Okay, so as I mentioned earlier, so one of the tactical opportunities is an eventual inclusion into the main index, right? But one of the more recent examples would be like the MPI delisting. So MPI has communicated their plans to get delisted way before, right? So they were just waiting for the right opportunity. So it's something that didn't entirely take us by surprise. It was just a matter of timing. So when we're given that information, we just took a look at what the fair value of MPI was, right? And then pick the price where we were more comfortable sitting in, just in case the delisting does not happen soon, right? So we were able to come in at a very comfortable price, a price that we liked in. And then the other side of that opportunity was that once MPI gets delisted and gets removed from the main index, who gets to replace it, right? So that's an example of a tactical opportunity. So there was a list that we were looking at, and eventually we identified Bloom. And not only does Bloom have the fundamentals to back it, it also had the size. So we then also positioned we positioned both in MPI and Blue. So that helped the fund's performance, especially this year.
Right. Actually, perfect. And segue to the other questions. We're getting a lot of questions about this.
Hmm.
Number four, fourth one. And before we address those questions about more in the process, we wanted to squeeze this in. Could you kindly delve into how the high inflation environment is impacting consumer behavior? You talked about this in the context earlier on the macro,
Yes. Yeah.
but especially regarding the postponement of high value purchases and down trading. Any
Yes.
specific sectors in the consumer space that is affected by this trend?
Okay. Yes. So we've seen this particularly with consumer discretionary companies. So high ticket would include furnitures, right? That's already high ticket items, and we've seen it from reflected on Wilcon's earnings, actually recent earnings, where we saw a slowdown in sales. Um, um, Cars would also be considered a high ticket item, but because of how it's being sold, where you can actually amortize the payment, they've gotten around the high inflationary environment. The other portion of the other side of that is the down trading in staples, right? So before, people were more comfortable about, or more loyal to certain brands at certain price points. Now they're just looking at substitutes, more affordable substitutes, right? And not entirely canceling that particular item itself. Although, if this high inflationary environment persists, we might see some postponement even in smaller ticket items. So, yeah, definitely it's showing up in big ticket items I mentioned earlier, like furniture or other finishings in or home improvement items. And then in the staples, people are just going to like cheaper brands first, or cheaper alternatives, and it's also showing up in some consumer retail in retailers and consumer staples like Pure Gold, and URC or CNTF.
All right, El, thanks for that. With this, it's going to be our last question, guys. Thanks for audience. Thanks for sending in the questions. But this last question, I think, should wrap up also the other ones as well. Very related to number three, the questions on MPI Bloom as well. Can you elaborate more on how you select stocks that are part of the Alpha Opportunity Fund? So diving a bit more into the process.
Yeah, sure. So let's talk about it in general terms first, right? So again, we always go back to our fundamental process. We're very fundamentally rooted. We have our own internal system of evaluating companies based on the industry that it's in, the quality of the management, third, the growth that we see, and then the valuation that we see, and then lastly would be the financial risks and the business prospect risks, but also which also bakes in some ESG actually and SDG considerations for the companies, right? Now, given the small to mid cap scope of the fund, we have certain thresholds that are specific to this stock universe, right? And so it's very important that we keep a high touch point with these companies to ride out, because they can be very, very volatile, right? Not just with their earnings, but also with their stock price. So yeah, high growth companies at affordable prices, so really good. Event driven companies, also really good for us. And that ties into like I think the last slide of my presentation. So first, particularly relevant now would be the pandemic beneficiaries first and foremost, right? So some consumer behavior were pretty sticky. So for example, maybe online deliveries or logistics or e-commerce, right? Digital banking, online gaming. That's what I highlighted in my slides, on my slides. Second, with all these pandemic beneficiaries, shifting consumer behavior. Third would be event driven, and then the fourth would be the value and value cyclical companies that we think we're just trying to ride that are able to ride out the high interest rate environment so far.
Okay, all right. Thanks, El. And unfortunately, that's all the time we have for questions today. But before we part ways, El, do you have any last words for our audience today?
Yeah, okay. Yeah, thanks again for giving us time this afternoon. I hope I was able to we were able to help you make more informed decisions with your portfolios. For those that are already pretty experienced in investing, and for those that are pretty new, I hope that we're able to entice you to start to get your feet wet and start investing, and hopefully you pick the Alpha Opportunity Fund. No, the Alpha Opportunity Fund is available in both Seed Box and ATRAM Prime. Prime caters more into the high net worth retail, so there's a minimum there. I think of 200,000. Correct me if I'm wrong. 200,000 or 250,000. And Seed Box is our platform for those that are below that. So it's widely available in those two platforms. So again, thank you so much for your time.
Thank you, Elle. Once again, we want to extend our gratitude to Elle for providing us with great insights for this webinar, and of course, to everyone in the audience for your active participation. And thanks everyone for taking the time to join us today. And now that we've discussed all the opportunities in the small to mid cap space, I think a big question is how essentially can we act on it? And this is one of the questions we sought to answer when we developed the app ATRAM Prime. It's our very own app that allows you to customize an investment management account and a personalized portfolio based on your goals and risk tolerance. With a commitment to long-term growth, you get a dedicated client advisor guiding you towards building your assets, which withstands the test of time. And for more information, let's check out the video quickly. It'll quickly be flashed on your screen.
Good day. ATRAM is the leading independent asset and wealth management company in the Philippines. If you are interested in investing in ATRAM Prime, download the app in the Apple App Store or in Google Play Store. You can also visit prime.atram.com.ph to know about ATRAM Prime. If you have other questions, you may fill out the contact form on our website or send an email. We hope this helps. Thank you.
All right. That was ATRAM Prime, and as Elle mentioned, you can invest with minimums of 100,000. And for those looking to invest for the beginner suite, we have Gcash, we have Maya, we also have Seedbox as well. So whether you're a beginner to the world of finance and investments or a more seasoned investor, as Elle said, we have these platforms available, and we've also got you covered via our social media pages as well. Our YouTube channel, ATRAM Studio, also has a collection of videos that features everything you need to know. As I said earlier, don't forget to like and subscribe. You can hit the bell notification so that you receive alerts on all your devices when we upload new videos and webinars just like this. So we have our Q&A portions and everything that you can stay updated. And all our social media pages can be accessed by scanning the QR code found on your screens. Before we let you go, we just want to kindly ask you to complete this feedback survey. Your feedback on today's topic will be extremely useful for us in our future webinars. And with that, we'd like to extend our deepest gratitude today for your participation this afternoon, and we wish you and your loved ones, everyone here, continued health and safety. I'm your host, Stanley, and good afternoon. We hope to see you in the next webinar, and please have a great day ahead.